It's time to buy these high-yield dividend stocks. These are the high-yield dividend stocks to buy as they represent quality companies trading at a valuation gap. Vail. Vail will likely benefit in the form of higher cash flows as iron ore trends higher, and the outlook is bullish for commodities on possible rate cuts. Altria. The smokable business remains the cash flow driver, and it has been gradually transforming toward the non-smokable category. Aker BP ASA. Aker has high-quality oil and gas reserves. An attractive break-even oil price ensures robust free cash flows. Let's dive in. Retirement boosters. Here are the 3 stocks with a dividend yield of over 8%. Welcome to Timely Investment Research. The personal savings rate in the United States was 3.2% for March. Compared to the long-term average of 8.47%, the savings rate is significantly low. Inculcating the idea of saving for retirement and other personal needs is critical to ensure smooth finances through the ups and downs. An important part of retirement saving is to consider exposure to high-yield dividend stocks. There are 2 key benefits. First, high-yield dividend stocks are generally blue-chip ideas that represent companies with strong fundamentals and cash flows. Holding these stocks for the long term is a source of regular cash flows in the form of dividends. Further, if the high-yield dividend stock is undervalued, there is room for significant capital gains over the long term. The focus of this video is on 3 stocks that have a dividend yield of over 8%. Further, these blue-chip stocks trade at a valuation gap. I see limited downside for these ideas from current levels, while the upside potential is significant. Number 1. Vail. Vail is an attractive name to consider among high-yield dividend stocks for multiple reasons. The obvious factor is that Vail stock offers a dividend yield of 9.6%, and dividends are sustainable considering the cash flow potential. Further, Vail stock has been a massive underperformer with total capital gains of 1.3% in the last 5 years. At a forward PE of 5.8, the stock is trading at a deep valuation gap. Even if the industrial commodity price environment remains volatile, Vail stock has limited downside from current levels. On the other hand, the upside potential is significant. A third reason is that iron ore is trending higher, and with potential rate cuts impending, it's likely that commodities will rally. For first quarter 2024, Vail reported its highest quarterly iron ore production since 2019. Copper and nickel production was also robust. Investment in assets that support global energy transition will likely reap long-term rewards. Number 2. Altria. Altria stock is another undervalued name to consider among blue-chip stocks. Besides trading at an attractive forward PE of 9, Altria stock offers a dividend yield of 8.62%. While revenue growth has remained muted, Altria has continued to generate robust cash flows. That will ensure dividends are maintained at current levels. An important point to note is that Altria is in a phase of business transformation. The focus is on driving sales in the non-smokable segment. However, the transformation will likely be gradual, and the smokable business remains the cash flow machine. Having said that, there are positive business developments in the non-smokable category. As an example, the company's NJOY device retail share has continued to increase. Similarly, the company's oral tobacco shipment volume has remained on an uptrend. It's also worth noting that Altria retired $1.1 billion of notes that came due in first quarter 2024. With healthy cash flows, deleveraging will ensure continued improvement in credit metrics. Number 3. Aker BP ASA. Aker BP ASA has remained under the radar, as the stock trades in the OTC exchange. However, there is no doubt about the long-term growth potential for this oil and gas exploration company. Besides trading at attractive valuations, Aker BP stock offers a robust dividend yield of 9.96%. As an overview, the company has high-quality oil and gas assets in the Norwegian continental shelf. As of 2023, Aker reported 2P reserves of 1.72 billion barrels of oil equivalent. Further, Aker has 2C resources of 810 million barrels of oil equivalent. Besides a strong reserve base, Aker has an attractive oil price break-even. The full portfolio break-even is estimated at $35 to $40 per barrel. Therefore, even if oil trades at $80 per barrel, Aker BP is positioned to deliver robust free cash flows. It's worth noting that the company has grown in the past through multiple mergers and acquisitions. With a robust liquidity buffer of $6.6 billion and a low leverage ratio of 0.2, Acre is positioned for aggressive organic and acquisition-driven growth. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.